Hello and welcome back to my channel. Thankfully, it's been a relatively peaceful week and so far there have been no further reports of more banks collapsing. Does this now spell the end of insolvency issues within the global financial markets? And can we now relax and go back to worrying about more important issues like the lack of fresh vegetables on supermarket shelves? It's probably too early to say for sure right now, but the good news is that we're unlikely to see a repeat of the Northern Rock collapse, which shook the banking system back in 2007. In this video, I'll explore the unique set of circumstances that actually led to the recent bank turmoil in the first place, and also provide some thoughts on what the impact on UK banks might be. The key question that's on my mind, and probably on your mind too if you've clicked on this video, is how safe is the money in your bank account? You might be an active saver with your life savings or an emergency fund held in a high interest bank account, or a stock market investor with money held on a brokerage platform. If you have significant amounts of money sitting in a UK bank account or financial institution, then this video will be useful for you if you've had concerns about the solvency of UK banks. With all the banking turmoil that's been reported over the last few weeks, it's really no surprise that some savers or investors might be questioning whether their money is actually safe. At this point in time, you're probably well aware of the downfall of Silicon Valley Bank and Credit Suisse. SVB was the 16th largest bank in the US and lender of choice to America's tech startups and died a visible death in early March, mainly due to a bank run which led very quickly to a liquidity crisis. This essentially means that lots of its customers, typically tech startup entrepreneurs and venture capital investors, all began withdrawing money out of the bank at the same time. The bank run was sparked after the bank announced that it had sold a large amount of its bonds at a huge loss and needed to raise money. This admission seemed to spook its tech startup and venture capitalist customers, whose deposits were typically much larger than $250,000 insured by the American government. Attempts to withdraw $42 billion in deposits within a single day led to the bank running out of cash. A few days later, we saw the same situation play out with Signature Bank, the 19th largest bank in the US, which also collapsed due to a bank run. The crisis was not limiting to the US, and the British arm of SVB suffered a crippling run of deposits also, due to a loss of confidence in SVB UK after the failure of its parent company in the US. However, in this case, HSBC bought SVB UK for £1 in a shotgun rescue deal, which prevented it from failing. The 167-year-old Swiss bank Credit Suisse was also hit by a crisis of confidence and a rapid withdrawal of deposits shortly after the SVB crash. This eventually led to a takeover by Switzerland's largest bank and Credit Suisse rival UBS, which agreed to buy the bank for a discounted price of £2.65 billion. Credit Suisse was also racked with issues before the SVB chaos, including fraud, money laundering, and last month reported its biggest annual loss since the 2008 global financial crisis. So all in all, not a pretty picture in the financial markets at the moment, and it certainly has been a hectic month for the banking sector. The high-profile bank collapses have caused ripples throughout the wider global financial industry, resulting in significant share price falls across most banks over the last month, including UK banks. But did all this turmoil in the US and Europe trigger a bigger financial catastrophe? And do we need to be concerned about any more UK banks being caught up in the potential crisis? And if a crisis is looming, which domino will be next to fall? The short answer from the UK government and industry experts is no, as they argue that the problems are limited to a few troubled banks. Both the government and Bank of England have issued statements backing the UK banking system, saying that while there is currently a lot of volatility in the financial sector at the moment due to the transition from very low interest rates to high interest rates, it is much better protected than it was at the time of the GFC in 2008. In fact, the Bank of England's own stress test suggests banks could weather an economic storm twice as strong as the GFC. So we're not expecting scenes from the opening of The Big Short movie just yet. The longer answer as to whether a global financial crisis is on its way is less clear-cut. We might not be heading for a carbon copy repeat of the 2008 collapse, but the banking sector isn't completely out of danger just yet, and there's no guarantee UK banks won't be further impacted. Recent events have planted a lot of fear, uncertainty and doubt in the banking system, and as a result, bank shares and bonds have been sold off sharply, and the FTSE 100 is down about 5% over the last month. You only need to look at the share price of any bank to see the downward trend. This kind of activity drives up the cost of funding, even for the most stable of lenders. The big concern is that high funding costs for banks will be passed on to UK households and businesses, should banks respond with caution when making new lending decisions. In other words, a credit crunch could be coming. After an aggressive increase in interest rates over the last 15 months, high borrowing costs, and now this newly added layer of bank instability, retail customers like you and I, as well as UK businesses, are likely to experience a further increase in the cost of credit. The situation is more visible in the US, where the chair of the Federal Reserve, Jerome Powell, warned last week that the volatility of the banking sector was likely to result in tighter credit conditions for households and businesses. A monthly survey of fund managers by Bank of America shows that a systemic credit event has now replaced inflation as the biggest concern in the financial markets. In the UK, higher borrowing costs and a tougher approach to lending by banks will make business investment harder, which is what the government was relying on to boost the economy. For everyday households, higher funding costs for banks will drive up the cost of financial products, for things like loans, overdrafts, credit cards and mortgages, etc. As to whether we'll see any more UK banks run into serious trouble remains to be seen, and isn't something we have any control over. However, there is a big reason why it's unlikely we'll need to worry about your own cash, even in the event of a run in a UK bank. This is because your savings are protected by the Financial Services Compensation Scheme, or FSCS, which applies to all UK authorised banks. Bear in mind though that you're only protected up to £85,000 per person in each institution, for up to £170,000 in joint accounts. The scheme guarantees that if the bank holding your cash goes under, the government will repay you within 7 days. I'll flash up on screen now the type of accounts that are and aren't covered by the compensation scheme, but it's worth noting that current and savings accounts, cash ISAs and cash saved within a self-invested personal pension are covered, but investment losses or cash in the PayPal account, for example, aren't. Also worth mentioning is that if you use an investment platform regulated by the FCA, it's absolutely compulsory for them to hold client funds in an institution covered by the compensation scheme. So you'll be happy to know that investment deposits are also protected. The £85,000 figure is so high that realistically most people don't need to worry about their savings disappearing into an abyss if their bank lapses. But there are a few factors that you should bear in mind to make sure your money is kept safe. Remember that the protection applies to each financial institution rather than per bank account. This means that if you're an individual with more cash than the £85,000 limit, you can protect your money, but only if you split it between different banks. But you do need to be eagle-eyed here, because there are quite a few banks that have several brands operating under the same single institution. For instance, HSBC and First Direct are the same entity, as well as NatWest and Royal Bank of Scotland. You've also got Halifax, Bank of Scotland and Lloyds Bank, which all fall under the same institution of Lloyds Banking Group. In these cases, the £85,000 limit is shared between them. So, if you had £60,000 in an HSBC account and another £60,000 in a First Direct account, that would be £30,000 unprotected and exposed. You'll also need to check that your deposits are within an institution regulated by the FCA or Financial Conduct Authority. If not, you won't be covered by the FSCS. But if you're not sure, you can use the link to the official Bank and Savings Checker, which I've included below. Almost all of the UK's traditional high street banks and building societies are covered by the scheme. But with the rising popularity of digital fintech banks over the last few years, it's definitely worth checking that these are also covered by the scheme. As an example, Revolut, the online e-money platform, operates like a typical bank, but doesn't have a full banking license, and that means no protection under the compensation scheme. A lot of the time, these e-banks keep your cash in trust with an authorised bank, which is subsequently covered by the FSCS. So in theory, you could recover your money. It just wouldn't be as easy to get it back. And there's also the risk that you might already hold money directly with the in-trust bank and have already exceeded the £85,000 £85,000 limit without knowing it. Another advantage of the scheme is that if you have way more than £85,000 in your account, say you're sitting on the proceeds of a house sale or inherit some cash, the limit you're protected for increases to £1 million for 6 months from when the amount was first deposited. You do need to be careful with this though, as there are certain exclusions, so if you know that a large sum of money is on its way to you, make sure that it qualifies under the scheme. Alternatively, you could look into keeping your money in an MSNI account, which is the government's version of a savings bank, and it's the only UK institution that guarantees 100% that your savings are protected, regardless of how much you deposit, with some accounts actually allowing up to £2 million to be held in savings. If you're a holder of premium bonds, then you already have an NSNI account and are automatically protected under the scheme. If you're not quite sure what premium bonds are, think of a cross between a savings account and the lottery. You have the opportunity to win cash prizes every month from £25,000 to £1 million, but the difference is that unlike the traditional lottery, you never lose your stake and you're automatically entered in the prize draw every single month. Only last month, the premium bond price jumped to 3.3%, making it the 5th increase in a year. This means there will be an extra £15 million of prizes up for grabs each month. To be honest, it's not the best in the market when compared to the top savings rates you can get at some banks, but it's still an option that you might want to consider. I think the key takeaway here is that everyday retail savers and investors like you and I don't have to worry too much about our cash disappearing if an imminent bank collapse is on the horizon in the UK. There's just no way to predict what exactly will happen in the UK as a result of the recent banking instability, but there are certainly things that we can put in place to make sure our money is protected should the worst happen. Holding accounts within FCA-regulated financial institutions and not holding all your eggs in one basket will definitely help to mitigate the risk. I'm really keen to hear from you guys. If you have money held in a bank account, are you worried about these bank runs and are you hedging against any potential risk in some way? Let me know in the comments below. As usual, thanks for watching this video and I'll see you in the next one.